Sandeep Bhatia, Executive Director, Head of Sales with Kotak Instl Equities, joins us live. Sandeep, good morning. Good to have you back on ET Now. Sandeep, we had a rewarding September, but in the month of October, Indian markets are consolidating. So is it a good time for those who have missed this year's rally to start accumulating now?
No, I think the earnings season is, we are in the midst of that, and earnings have been fairly okay. I don't think they have been great. I mean, valuations are up. Expectation earnings have been beaten down. I think people have to essentially focus on ideas which will deliver at least 18 to 20% earnings growth. Unfortunately, it's difficult to find these ideas at reasonable valuations. But we think that with interest rates headed down, banking sector, which is a big rate sensitive, and autos seem to be good places to park your money. So yes, you can enter there, but you have to be very selective, focus on earnings growth, and hopefully try to find some reasonable valuations.
Ultratech Cement as well has gotten off to a very good start, and so is the case with TCS, both reacting to their earnings. Sandeep, your thoughts on what we've seen from the IT majors up until now? Wipro awaited, but HCL Technologies, TCS and Infosys, and clearly has TCS now booked the top slot?
Definitely, in our own target multiples that we assign to the IT sector biggies, TCS is the highest at 16 times forward. So clearly this is something which, and the market is in fact giving a higher multiple than even that. So yes, TCS has booked the top slot. The pecking order has changed. I think what's good to see in TCS numbers is good volume growth. Of course, margins are taking a hit, but that's a fact of life for every big IT company. HCL Tech, in fact, has the only company which has managed to buck the trend. So overall, I think TCS is clearly the leader there.
So at 15-16 times, is TCS fairly priced or it is expensive? Because they're doing all the right things. On such a large base, they've managed to report a 4% growth, which to my mind, is quite murky.
Yeah, I think the market believes that this is a good enough earnings growth. But we are a bit cautious on the entire IT sector, which is why our multiples are just 16 times forward. But the market is in the mood to give higher multiples to TCS. So beyond a point we can't argue. But I think what one has to realize is that the sector has also benefited in terms of rupee depreciation. So if that is something which will go away going forward, then earnings growth will actually fall in rupee terms than what we have seen in the last 1 year.
Sandeep, what did you make of the cement earnings? Ultratech, of course, over the weekend, delivered an impressive set. And of course, there is talk about perhaps Holcim charging a 2% higher royalty from ACC and Ambuja, which sort of dampened the stock movement.
I think the entire cement sector has done well. You saw Shree Cement results, which were also good. I think that two parts to the whole story. One is the broader trend that any consumer-driven business, a business-to-consumer kind of a stock does well, which is why most of and any business-to-business stock is in a poor condition. So whether it's infrastructure or whether it's even the IT sector, they are facing rate pressures. So clearly, cement benefits from the business-to-consumer uptick within the domestic market. And I think this sector will continue to hold. To some extent, the entire sector also benefited from the late start of the monsoons last quarter. So to that extent, they had a stronger sales in the beginning of the quarter. The monsoon did not hit them. But I think we are going to see some sort of a growth rebound going forward. So cement will definitely be a beneficiary. I would continue to look at that positively.
Sandeep, you track the oil and gas space pretty closely. Your take on what we've seen from Reliance Industries and what you're expecting from Cairn today?
On Reliance Industries, one can say, both for Reliance and Cairn, I think they're close to fully priced. Reliance does not, inspire much confidence in terms of big earnings upgrade. Maybe we have to wait for another 2 years before we see big earnings upgrades come through. So in some of the operating, some of the buzz around refining margins going up, I think is very short-lived in our view. Commodity prices are broadly headed down. There is no big shortage of refining capacities. So to that extent, it's neutral weightage to underweight on Reliance for us.
Okay, ITC came out with numbers on Friday and the stock is holding on, 294 rupees for ITC. Sandeep, to your mind, do you think ITC is now moving up because of delivery and because of numbers? It's no longer, a defensive stock. The reason why ITC is closer to 300 is because they've come out with another quarter of excellent growth. They managed to expand their profit margins, and cigarette volumes for the quarter gone by, that has registered a marginal uptick.
No, if you see the largest, most important business, which is the cigarette business for ITC, we see, continued surprise. We were expecting flat to negative volume growth for the full year, but they are done better than that. Margins have, of course, improved. The underlying operating growth from the cigarette business over longer periods is at least around 14 to 16% in that band. On top of that, I think some of the losses in the FMCG business has come down. The only weak spot I see broadly in the results is just the hotels business. I hope we see an uptick in the second half of the year. So overall, ITC looks good. Valuations have moved up. But in this market, as I say, business to consumer stocks will continue to do well. I think the investment cycle will take some time to rebound. Expectations are that things will start moving very quickly, but I think it will probably take at least another 2 years, or maybe installation of a new government, to see the entire investment boom come again. So I would think business to consumer stocks do better.
But are you surprised with the cement dispatch numbers? I'm revisiting cement, and the reason why I'm revisiting cement is that at a time when the industrial demand is broken down, the Indian housing sector is some kind of a mess. The cement dispatch numbers are impressive. So who's buying all the cement?
The quality of macro data, I find it very difficult to trust. It's better to look at industry associations which also come out with data. So to that extent, if the numbers, whether in cars or the cement, are a better trend of what's happening, at least in those industries, I think it's essentially people are still constructing their own living and houses. So that's fine. I mean, it's broadly tracks consumer demand in the economy, which is, as we all know, held up much better than most people expected.